What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about cash, all right? So there was a report that recently suggested that cash is not worth holding on to right now, even though the real yields are actually positive. After a very long time, we've got actual yields that are positive after accounting for inflation. So we're going to break down some of the management, cash management in this video. I'm going to break down my example, what I personally do, and I'm going to show you actual proof on how I actually manage my cash. So I hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below, of course. If you're interested in joining, there is a 16% annual discount available for the next 2 days. So today and tomorrow, you can take advantage of that. And not to mention our fundamental tech analysis courses, currently 50 to 60% off on the observance of Labor Day. So coupon code is going to be Labor4, and that's also going to be available for the next few days if you want to take advantage of that. So all the links are going to be down below in the comments and of course pinned in the description as well. So this right here was the report. First of all, this is what we're talking about, right? Hard cold cash. That's, obviously everyone has it. Everyone's in their brokerage account, bank account, whatever it is. But this is what we're talking about. So for the first time in ages, it pays even after inflation to hold cash. And that's true because real yields are positive, right? Real yields are basically nominal yields minus inflation, and that's your real yield. And high yields could disguise a pitfall for investors, warned an investment strategist at Wells Fargo. So what they're saying is that even though real yields are positive, it's not worth holding on to cash. In May 2023, the yield on the 30-day, not 30-year, 30-day U.S. Treasury bill topped 5%, right? So we're talking 1 month treasuries. You can even come over here to our charts. I've already gone over them in multiple of my videos, multiple of my live streams, but let's just go over that again. So shorter end of the curve, we've got, yields from anywhere between 1 month to as much as a couple years, sitting very nice and very tight at over 5%. So 6 months sitting at 5.5, 3 month is sitting at 5.5, 1 year sitting at 5.4, 2 years sitting at 4.9. Of course, the longer you go out in duration, the lower the rates are starting to be. And that's the concept of an inversion of the yield curve, which we have again talked about. This is the credit spreads are actually negative, right? So in other words, the yield spreads are negative. So if you go over to 0MY, that's going to be the 1 month bond yield. This is what they're referring to at 5.4%, right? When they're talking about it in this article. So it stood at 5.384%, 5.435 right now. It's pushing up over 89 basis points. Tuesday morning, and certificate of deposits, so CDs and high yield savings accounts paying north of 4%. That's true because even money market accounts and government-backed securities are paying you anywhere between 4 to 5%. Meanwhile, inflation as measured by the consumer price index has fallen from about 9.1 to 3.2%, right? So now real yields, which is again these rates minus inflation 3.2% is positive. As a chart below from WFI Wells Fargo 2 shows, cash yields moved into positive territory on real inflation adjusted basis after a few years of negative real yields. This is a chart they're referring to. So now we are in the positive territory for real yields, when of course we've been in negative territory for a very long time because inflation was higher and these rates were significantly lower. Now, the shift to a positive real cash yield environment has investors wondering if it's time to increase cash holdings or hold on to cash as they await better opportunities in the market. But parking too much cash in the portfolio can have, quote, unintended consequences is what they mention. And the problem is that even if cash yields remain elevated in the short term, history shows that cash is likely to underperform other growth assets over the long term. So their basic thesis here is that don't hold cash because long term it's going to be an underperforming asset. And this is what they represented, basically suggesting that history has shown that even a very conservative allocation such as a moderate income has returned more cash over longer periods of times, right? So this is moderate growth liquid over 175%, moderate growth income liquid 145%, moderate income liquid 99%. This is the 15-year cumulative return versus cash only returning 11.8%. Now, Ray Dalio has also mentioned in the past where cash is trash, right? But more recently in February, so earlier this year, he mentioned that cash is a better investment than stocks and bonds as the Federal Reserve sticks to its interest rate hike plan. And Dalio's U-turn on the dollar comes as the Federal Reserve continues with its most aggressive campaign of interest rate increases since 1980s to control inflation. And cash used to be trashy, is what he says. And cash is pretty attractive right now. It's attractive in relation to bonds. It's actually attractive in relation to stocks, is also what he mentioned back in February. Now, the reason to hold or to not hold cash is a more tactical decision, right? Because in my opinion, and what I do agree and disagree with. So I agree with the long-term thesis that cash is not worth holding on to. And the reason is because we know that overall inflation continues to go up. We know that prices back in the 1930s, 1900s are nowhere near close to what the prices we're paying for consumer goods and services today. So overall inflation continues to go higher. So cash is not really worth holding on to over the long term. However, it is when short-term tactical allocation gets interesting based on valuation, based on the yields, based on the return, is where you want to fluctuate that cash percentage in your portfolio so you can take advantage of that tactical allocation, right? You want to take advantage of that market environment, right? So if yields were nowhere near close to where we are right now at 4 to 5%, obviously nobody would be interested in holding on to cash, right? Everybody would want to be invested in the market so that we can actually generate a higher rate of return compared to inflation. But because yields are higher, in my opinion, at least in the short term, on a more tactical basis, I think it makes more sense. I think it makes much better sense, and I kind of agree with Dalio that it's more attractive to have some exposure to a 4 to 5% paying bond or money market fund or anything, right? Corporate bond, government bond, something that actually pays you 4 to 5%, and that's safe and liquid. And this right here is how I basically operate on a cash basis, right? So this right here, let me just go over what my current cash exposure is. So right now I'm sitting at 25% is going to be currently my cash exposure. I actually mentioned this in our Discord earlier in the week, and the fluctuations between are going to be between 8 to 30%. So that 8 to 30% is basically me being a little bit more tactical with respect to understanding market valuations, understanding the current yields, understanding other different products and instruments that can yield me a little bit higher than the next best alternative, because I want to keep this liquid. I want to keep this as a way for me to use this for opportunities and again, have cash available for opportunities, right? So in an undervalued market, I see myself kind of dipping down to 8 to 12%. That's kind of like my floor. That's about as low as I could see myself going. I think the lowest I've ever gone to is like 7 or maybe 6%. That's, when the markets are like incredibly cheap, like super undervalued levels. Like I know for a fact the markets are just selling for a huge discount. When the markets are overvalued, right, trading at a huge premium, and I consider for the market valuations to be a little bit more frothy, kind of taking a temperature of the markets, and they're not really that cheap. Instead, they're very expensive. Then my cash exposure gets from 18 to 30%. If it's fairly valued, it kind of fluctuates between 12 to 18%. And right now, as you can see, that right now I'm at 25%, so you can kind of tell what my market positioning is, right, where I basically see the markets right now, right? They're not cheap. They're not inexpensive. They're not trading at a discount. This might be a little bit higher than usual. That's only because, again, I'm saving for a home purchase as well. So it's a little bit higher than usual because I do consider the markets to be somewhat fairly valued to maybe borderline overvalued. So, I would be more comfortable at like 19 to 20%, I think would be reasonable. But like I said, I am saving for a home purchase, so I do need a significant amount of money for a down payment. So that's why my cash exposure is high. But let me give you some case studies, right? So this is me in August 2022. So this is last year, right? So we're going back 1 year before. And of course, markets were in absolutely getting crushed back then. And you can see that I basically mentioned, this is in August, on August 4th, 2022, I mentioned cash exposure now sitting at 9.5% for me. So you can see how low I got down to at that point because the markets were obviously selling off pretty aggressively. We had the Jackson Hole Economic Symposium selling off like in August, September, October was brutal. Markets just straight up down. And I remember getting down to, I think, as low as 8% during that time because I was selling puts and I was dollar cost averaging and buying a lot. And then I also mentioned that I'm looking to build it up to 12% so that I can, take advantage of more opportunities, kind of have that more dry powder. And that's, going to happen either through cash coming in from my savings or from, my income, or maybe just selling some stocks, profitable stocks, to raise more cash. Like I did for InMode, trimmed another 100 shares, at 22% profit, freeing up cash and locking in some gains, right? So that's another way for me to raise more cash at those levels so I can, again, reallocate a little bit, buy stocks that are undervalued. Now, if you fast forward to where I'm at now, this right here is June 29th, 2023, so just a couple months ago. And now I pretty much mentioned these are my top 7 positions. Tesla, obviously the top, 29-30%, although this has been lowered a little bit because prices come down. Meta, it's no longer at 9% because I've sold calls in Meta. I've been able to trim. I've kind of gotten rid of some of the Meta, a huge profit, and cash 23.46%. So you can see from 1 year ago, it went from like 8%, 9% to over 23.5%, and right now sitting at almost 25% as well. So, there's no right or wrong answer when it comes to cash exposure. Only what works for you, right? Only what is comfortable for you in terms of that cash exposure. If you're comfortable with, hey, 50% cash that allows you to sleep better at night, that's totally fine. If you're comfortable with being fully invested in the markets, 100%, having zero cash, that's totally okay as well. As long as it works for you, I think that's what's really important. There are some general principles, like you need to have at least 6 to 12 months worth of savings in emergency funds, right? So if you lose your job, if something happens, at least you have that rainy day fund where you can kind of draw from and still keep looking for a job, still keep looking for new income source. So that's like a more generic principle that you must follow, in my opinion, at least. But then other than that, if you are saving for a home, saving for something else, if you are invested, I mean, that percentage totally depends on you and your risk preference, right? So there's no single number that I can tell you that, yes, 20% should be in cash. No. What works for you is what works for you, right? What works for me is this number I just showed you guys, that it fluctuates between 8 to 30%. It's like a sliding scale, right? Goes up and down depending on the market situation. So I hope you guys enjoyed this video. And again, it's a little bit of a report slash educational. Make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord, Patreon is going to be down below. 16% annual discount available till the end of this month. As always, happy investing, and I'll see you all in the next video.